Wema Bank it was in the news last week regarding a new commercial paper on FMDQ, OTC Securities Exchange. So we're going to put that stock chart out there to look at the share price of this particular Tier 2 bank. And that's it for the Omotola. Talk us through this point of value. This is a stock that's gone below water as well, below about 50 kobo so far in 2017.
Right.
What is Wema Bank looking for, really, and where's the direction?
Well, Wema Bank is a Tier 2 bank, and like most Tier 2 banks, they are facing cost of fund issue. Because of the high interest rate environment, their cost of customer deposits and the cost of the loans that they've obtained as well, it has gone up. So if you look at their half-year results, for instance, you will see that despite a growth in their interest income, driven by the high interest rate environment, their interest expense is growing faster. So their net interest income grew at a marginal 0.1%. And the result, the 8.8% growth in net income was mainly supported by their non-interest income. So for a number of these Tier 2 banks, they'll be looking at alternative ways of trying to raise capital, to probably reduce their cost of fund. But we are not totally in agreement with the method they are using, because the average yield on commercial paper issuance right now is about 20%. So and for a bank already recording 8.1%, weighted average of its deposits, or rather weighted average of its interest-bearing liabilities, having
you go to another commercial paper
at over 20%.
At over 20%.
So it might not be optimal, but what we suspect is that because commercial paper issuance, they're mainly used for working capital purpose, for bridging liquidity gap.
This is a lifeline.
So this is a lifeline. Perhaps,
this is a lifeline
to sustain operation for the bank. Of course, the reason why we have that poor sentiment on the stock, because it's trading at 50 kobo now, which is the nominal value, for stocks on the stock exchange. And the reason why we have that low level of valuation for the stock is because, number one, it generates very low return on equity. Its half-year return on equity was barely 5%. So that is a cause for concern for an investor. And the second cause for concern is its negative retained earnings. Because by CBN rule, a bank cannot pay dividend with negative retained earnings. So it's carrying the retained earnings in deficit of over 30 billion in its books. So which means that for a number of years, they have to continue generating very high profits.
Wema Bank is not paying a dividend anytime soon.
Anytime soon.
Anytime soon. That's the bottom line.
That's the bottom line.
Finally, we got about 2 minutes or so. Let's talk very quick. Let's get you to chat to this aggressive buying into GT and Access Bank last week. Massive, almost 130 million cross deals in GT Bank, and Access another almost 10 million or more. This looks like very significant transactions on these Tier 1 lenders.
Yeah, they are quite significant transactions. From discussion with our sales team, the increased volume of transactions is being driven by institutional investors, some offshore, a few of them domestic. And the reasons are not far-fetched. The two banks are in the top tier brackets of the banking industry universe. They generate very high return on equity. The outlook on their earnings is quite positive. They have very low cost of fund, and with the high interest rate environment, they're able to generate very high growth in interest income. So if you look at their half-year earnings, for instance, they were quite stellar, and the outlook remains very positive. So for these two banks, they're amongst our top picks in the industry.
Let's continue from here and switching gear into these MPC decisions. What are your views? What are the views from AfroInvest?
For us, we align with consensus opinion that the MPC will be retaining all policy rates at their current levels. And our views, they are being shaped by two considerations. Number one, if you look at external sector statistics, we have seen improvements in those variables, talking about the exchange rates, talking about the level of capital importation, talking about capital market performance. We have seen improvements over the last 4 to 7 months when the CBN implemented the reforms in the FX markets. However, the big elephant in the room still remains price stability. The level of the inflation rates, it has been dropping expectedly from a high of over 10% in February to about 16.1% now. However, the rate at which it has been declining, it has been underwhelming, compared to what analysts had expected before. And the major reason why we are seeing that pressure is because we are seeing pressure from the food baskets high food prices. So on one hand, what the CBN might want to ease, because there is now improvements in external sector variables from exchange rates down to capital importation. The major arguments for maintaining status quo would be to look at level of price stability.
I am surprised that none of you that have read your reports seem to be in sympathy with those two members of the MPC last meeting in July that rates should be cut for 14%. How come none of you are in sympathy with those two MPC members?
We are in sympathy with them, and we are in sympathy with the manufacturing sector as well, because if you look at the news today, most firms, they've been clamoring for interest rate reduction. Prime lending rates in the country today is above 16%. Maximum is over 25%, which is quite high for manufacturing sectors where margins are low. Margins are between anything between 5% to 15%. You know, so it is not really profitable for them to be borrowing from commercial banks at these rates. However, the reality is that we have a bit of contradiction in monetary policy at the moment. While on one hand, the CBN has driven up market rates to a very high level, they have been advancing some credit facilities, right, to the federal government. So what we are seeing is essentially a crowding out of the private sector by the federal government. Credit to private sector as of July, it has grown by less than 1% year to date, right? But we are still seeing very high growth in money supply. So where is all that money coming from? It is coming from the fiscal spending we are seeing in terms of FGN intervention in state finances, in terms of the monetary policy, the expansionary monetary fiscal policy by the federal government to support growth.
Let's wrap it up. I understand what you're saying, but let's make it easy for the man on the street, which means right now, as of today, September the 25th of 2017, the federal government is the big boy on the right hand and on the left hand.
Correct.
The federal government is the one funding the economy, is the one borrowing from the central bank.
Correct.
Is the one central bank is lending to.
Right.
So head or tail, this is a federal government economy.
Essentially, partly so, which is why we think that for us to achieve a low interest rate, at least in the short term, there has to be a coordination, not between monetary policy and fiscal policy.
Let's leave it there till tomorrow. Let's leave everything there till tomorrow. Omotola, Abimbola, thank you very much for being here this morning. Of course, tomorrow, our panel will be live here at 1:30, from 1:30 in the evening, in the afternoon tomorrow, just lunchtime. So grab a quick lunch and join us then. But tomorrow morning, business morning, we'll return at the same time, 10 o'clock local time here on Channels Television. I'll see you then, everyone. And of course, in the afternoon, a very great day with our panelists from Abuja and here in Lagos. And of course, a live broadcast of the MPC communique. I'll see you then. Have a great day.